Fake data from unaccountable charlatans is having a very real impact on markets today, and we see Bitcoin's price absolutely cratering, trying to find its strength just above $90,000. But behind the closed doors of these Fed decisions, there's a distortion of truth that is leaving everyday investors absolutely crushed on the charts right now. But fear not, there is still hope. If we understand what's actually happening in the background, we can better protect ourselves and our financial assets as we move through this chaos. Welcome into the blockchain basement, and I'm your host, The Druth. Now today we have seen some insane Bitcoin price manipulation, especially if you're looking at this on the 1 hour chart. Let's just take a quick look here. Absolutely ridiculous what's going on. Just a stair step up, hour after hour green candles, and then gut-wrenching pullbacks 2 times now, really trying its best to find support barely above the $91,300 level. But honestly, this is not looking good, folks. We are entering realms that we feared might be playing out on the head and shoulders pattern. You got your shoulder, you got your head, you got your shoulder. So when we're looking at this and the downward pressure, we've definitely highlighted we could see a drop down to $77,000 if this plays out as it's showing. And something we haven't seen in quite some time, BlackRock ETF holders are selling. This is crazy. From Arkham Intelligence, guys, has some bad news. BlackRock is not buying. In fact, they are selling. This is the first set of outflows we've seen in a very, very long time from BlackRock ETF holders. And it leaves you with the question, why isn't the FOMO kicking in big time before the return of Donald Trump, who's so pro-Bitcoin? It's going to be coming out of his ears as he's on the podium in 2025. But there's a reason why the markets are feeling so scared right now. Fake job data is creating a fake reason for the Federal Reserve to keep interest rates higher for longer. If you take a look at the CMEgroup.com's probability tracker for the federal rate moves, we do see that 97.3% of the respondents believe that the interest rates are going to remain at the levels we've seen. And here from Kobayashi letter calling for the Fed pivot to be officially dead. Stocks are crashing after the U.S. added nearly 100,000 more jobs in December, and you would expect this to be bullish, right? Wrong. There is some devil to this detail, folks. Now, the unemployment fell to 4.1% as well, just after the Fed said that the labor market was weakening. So why are stocks crashing? Let's dig in. Kobayashi letter did a great job on this. Stocks are trading sharply lower after the jobs report, even though it came in stronger than expected at first. It seems to not make sense, but why would the market crash if the U.S. jobs market is actually stronger than expected? We must first explain what happened in September. This is the stock crash as labor market data comes in stronger than expected. Here is the Fed policy statement from September 24. The Fed began with rate cuts at 50 base points for the first time since 2008. We were highly critical of that decision. When it happened, there's reasoning that the jobs gains had slowed and inflation was heading to their 2% objective. But the crazy part about this is since then, the exact opposite is now happening. Job gains are accelerating and inflation is clearly back on the rise. This effectively destroys the need for any future Fed rate cuts. The labor market is strong and inflation is rising. We need higher rates, if anything. But the devil in this detail, folks, is they've been riding off of fake jobs data. And the data is changing in a huge way, really leaving market participants with very little trust in the data in and of itself. This is a great highlight from Nix. Then I completely agree with it. In February or March of 2025, you're going to see this number that was just released become revised as well. It will be a U.S. lost jobs, 75,000 jobs versus the 100,000 addition. Why, you might ask? The cynics feel this way is because 9 out of the last 12 jobs reports have been revised downward, and the Biden regime added 1.6 million jobs that were fake for the Federal Reserve to make these decisions by. Trump has been warning about these high interest rates as he gets ready to become the 47th president of the United States.
We are inheriting a difficult situation from the outgoing administration, and they're trying everything they can to make it more difficult. Inflation is continuing to rage, and interest rates are far too high. And I've been disappointed to see the Biden administration's attempt to block the reforms of the American people and that they voted for. We had a landslide election.
Now, there is some hope in these words that Trump's putting out there, because we got to remember the last time Trump said something was too high. We're going to revisit that right now. This is from Julian Patel. The last time Trump said something was too high, it was the dollar back in January of 2017, just days before his inauguration. Here's what he said: "Our companies can't compete because now our currency is too strong and it's killing us." And he's talking about competing against China. Last year, he also called for the recent strength a tremendous burden on U.S. businesses, talking about the U.S. dollar. Trump understands the impact of a strong dollar, and the same logic applies to high interest rates. They surpass exports, they hurt corporate earnings, and they slow economic growth. So what happened next? Back in 2017, the dollar began a significant decline, setting the stage for one of the most pivotal macro moves we've ever seen, triggering a melt up in risk assets. Deja vu? Potentially so. Let's see how this plays out. And this is just a highlight of that time frame compared and overlaid to our current situation. This is the Dixie today in the pink line, and the black is the Dixie in the 2016 to 2018 timeframe. The Dixie fell hard in the 2017 timeframe, setting up for an explosive move for risk assets. So much crazy stuff going on the macro markets. The graph for Bitcoin looks like an absolute war zone right now, so be careful if you're out there trading this market right now. More so, I'm interested in adding to my DCA and long-term hold positions, but you do you, boo. If you are trading out there, use our link 2bit and our code BASEMENT, and make sure to keep your assets safe and in self-custody. Cold storage, folks. Use the link in our description. Use code BASE10 to get your hands on an Arculus wallet right now. While we see all this chaos unfolding on the macro markets, it's important to know that fiat currency is dying. This is why I choose Bitcoin to become my own bank and make sure to hold my assets for myself so I'm not exposed to these systems crumbling. I think 2025 is going to be a great year for crypto. It's just going to be a bumpy ride on our way up to the top. So make sure you're locked in, and I'll see you on the next one. Truth out.